Hello, everyone. This is Darrell from the WealthSpire investment team, and this is Markets in 2 Minutes. So our last edition of the series took a deep dive on how we've been thinking about potential risks associated with the recent banking sector volatility. And so we thought we would take a step back here this time around and look at the marketplace at a more macro level and provide all of you with some context around how return expectations have evolved. So twice per year, our team goes through a rigorous process by which we attempt to approximate what we believe returns and risk will look like going forward for a variety of different asset classes. And we do this through a multi-decade lens. And the primary reason for that is that financial planning itself is a lifelong endeavor. And so that makes us inherently long-term investors. So as a result, it just makes sense for us to orient ourselves with a long-term outlook when we're making portfolio management decisions. And so what you're looking at here is the year-over-year changes in expected return for a conservative portfolio comprised of 25% equities and 75% bonds, as well as a much more aggressive portfolio of 85% equity and 15% bonds. And one of the interesting things that has happened over the last 12 months is that as interest rates have moved dramatically higher, the expected return for bonds has followed suit. And while equity expectations have also gone up, the order of magnitude has been a lot smaller. And you see that borne out at the portfolio level here, where this sample conservative portfolio is seeing an increase in expected return of over 1% as compared to last year, whereas the aggressive portfolio only has seen an increase in expected return of about 0.5%. And the next slide illustrates this in a slightly different way. Here we plotted a variety of different projections for portfolios and asset classes. And while there's a lot of data here, I want to direct your attention to the two sets of red dotted lines. On the left-hand side of the table, where you will find kind of lower levels of volatility and therefore more conservative investments, you can see that the difference between 2022 and 2023 expected returns is much larger than it is on the right-hand side, where you would find more aggressive portfolios. This represents what we would refer to as a flattening of the efficient frontier, which is really just a fancy way of saying that as investors get more aggressive, the extra return that they can expect to pick up by doing so has gotten smaller. This is something that's going to be important for investors to keep in mind as we might be thinking about portfolio positioning and how their current allocations might align with their appetite for risk in what is becoming an increasingly uncertain environment. As always, your financial advisor will be well positioned to help you think through these trade-offs as it relates to your own unique situation. So feel free to reach out to our team if you are interested in discussing this further. In the meantime, that concludes this edition of Markets in 2 Minutes, and we'll see you next time.